I tend to wonder. We're going to spend the first half of this hour talking about strategies for small business owners and those of you who are sole business owners, such as consultants. And then we'll flip it and spend the second half of the hour talking about strategies for individual. We're going to cover strategies for retirement planning, investment planning, and tax strategies. So first of these for small businesses is to use a pension plan. You want to be able to save money by putting it in a pension plan. You get it off of a 1040, you minimize taxes, and you also maximize the investments that you use. I've organized these. The one on the left is the SEP pension plan. It's the most simple. The one in the middle is the simple pension plan. It requires a few more forms. The one on the right is the most complicated. But again, these are all do-it-yourself, fill-in-the-blank kind of pension plans that you can set up for your small business. The SEP pension plan has been around quite a while. If you are operating on a flow-through business, LLC or Schedule C, it's going to be about 20% of your bottom line. You can tuck that and defer that into a SEP pension plan account, and then you won't pay taxes on that. You can take a look at the first $280,000 of compensation. So the maximum you can defer over into a SEP is going to be $56,000, which will save you quite a bit of taxes. If you have a small business and you have employees, you can put up to 25% of their W-2 salary over into a SEP-IRA account for each of those. The downside of the SEP plan, if you have employees, is that you have to put the same percentage in for each employee. So if you think you want 25% of your salary in, then you have to do 25% of every other employee's salary too. So usually that's going to drop it down. The nice thing about the SEP is that you do not have to contribute every year. So if you have a bad year, you don't have to put money in. What I like about the SEP, and I just did one of these for a client about 3 weeks ago, is that it's pretty simple. I operate out of Schwab Institutional, and Schwab, of course, has 4 forms that they want filled out for themselves. And then they have the actual SEP pension plan form, which defines it. Schwab's form is 5 pages. But then in small print, they say you can use the IRS's 5305 if you want. And that's what this is. I mean, it's that simple. It's a 2-page form. The other half of the first page is all instructions. The second page is instructions too. I play a lot of tennis at Overland Park Racquet Club. And at the front desk there are a lot of young people who come and go, maybe 3 months at a time. But if you have a set, let's say that I own Overland Park Racquet. I could set up a SEP with some of the long-time employees. I could contribute into a SEP plan. Let's say I don't really want to include these young people that I think is around us, right? Well, this form lets me do that. I can say that I'm not going to contribute for 18-year-olds or 20-year-olds. I'm only going to contribute for 20. And that might solve my cost on the employee. Or there's a second line in the IRS. I can say that I'm only going to put in money into the file if you can work it for me 3 out of the last 5 years. And that might really accomplish what I want. It might give some people an incentive to stick around. And I really want to reward my long-time employees, right? So the other boxes we don't go into because but setting up a SEP pension plan can be a really quick thing to do. Oop, let me go back to this. The other thing I wanted to talk about, I think other CPAs get confused on this. You can put money into you're going to end up, if you set up a SEP plan, all of your employees and you will end up with an account at a brokerage or a bank that is entitled SEP-IRA. That account is totally different than a regular contributory IRA or rollover IRA account. That's your own individual. This SEP plan is a qualified pension plan. So you can put $7,000 into a SEP if that's what your number ends up with, and you can put $7,000 or $6,000 into a regular IRA. The same $7,000 of earned income qualifies you for both. It's not an either-or situation. The simple pension plan takes a few more forms. It's not quite as easy to set up, but from an employer's perspective, it's worth it to do it. You have given your employees a pretty nice advantage by doing so. The maximum you can contribute is $13,000 in there. There's a catch-up if you're over the age of 50 for $3,000. This is a good pension plan if you have 100 or fewer employees. The nice thing that employers like about it is that the employers don't put the money in, the employees defer their salary in there. But what's nice from an employee perspective is you've just given me a way that I can defer $13,000 or $16,000 into a pension plan, and I don't have to pay tax on that. Furthermore, that $16,000 stays in that account and grows without the headwind of taxes until I reach retirement. That's the best you can get. So as an employer, this is a great pension plan to set up. You do have to contribute in the tough years, which is one of the downsides, but you do have some choices. You can contribute up to 3% of employee contributions, or you can contribute 2% of all eligible employee salaries. So let's say that I have 12 employees. Let's say that 7 opt to participate in the simple, which is pretty typical, not that unusual. So my first choice says I have to contribute 3% of what each of those 7 employees have put into the simple pension plan. And that's not that big of a commitment. Let's say that they maxed out at 16, 3% of that authority. That's not that. My other option as an employer is to take 2% of all eligible employee salaries. So I had those 12 employees. Let's say that only 11 qualify to participate in pension. So I'm talking about 2% of those 11 salaries. And I can take the lower of these numbers in a given year. The nice thing about the SEP and the simple and the SOL 401k we'll talk about in a minute is that you don't have to do much once you get it set up. On the SEP, you do have to pass out that 5305 every year, if I can get back to that. This you have to pass out to all employees. It lets them know that you have a qualified pension plan here, and it lets them see if they qualify or not. That's why you have to do it. On the simple, we can go to that. On the simple pension plan, you do have to hand out every year to all employees a participant notice. And again, it lets them know what the parameters were when you set it up. You also have to hand around a second form on the simple, and that is the elective deferral, because that form lets each employee decide how much they're going to defer into their own simple-IRA account. And that goes to your payroll person. So again, there's no annual filing or anything beyond that. It's pretty simple. What I like about the simple plan is that you can earn $16,000 and put all $16,000 if you're over the age of 50 into that simple-IRA account, and you don't pay taxes. And I have a client like that. She had a consulting business, a personal training business for Pilates for seniors. She was especially trained in that, and she didn't do it full-time, obviously it was a part-time gig, but we didn't want to pay taxes on that. She had other means, and so we set up a simple plan, and we were able to just defer all the money into that and keep it for retirement. So we didn't have to pay tax on it, which is what I wanted. The other nice thing about all 3 of these pensions that we're talking today is that you can be a Schedule C sole proprietor, you can be an LLC, limited liability company, you can be an S Corp, you can be a C Corp, and you can open any of these types of pension plans that we're talking about. And again, I guess this is sort of my soapbox. Let's say that you make $7,000. You have earned income then of $7,000. You can defer all of it into this simple pension plan. You can also come over here to your rollover IRA and from another source put that same $7,000 in, because the same $7,000 of earned income qualifies you for both. It's not an either or, it's a both. You can set these up at most brokerages. I work out of Schwab Institutional, so it's a fill in the blank there. I'm real sure Fidelity does it the same way, and TD Ameritrade. Vanguard will let you do it too if you're on your own as an individual. So most brokerages will do it, and there's no charge to these. Then the final one is the sole 401k, and that's appropriate if you are on your own or you or and your spouse own a business. You don't want to do this one if you have employees. I've used this for doctors where we are saving big bucks every year trying to race to retirement, or for, doctors who, the one I'm thinking of, he wanted to retire at 55. So we were really socking away a lot of money every year. The sole 401k has two pieces to it. On the first piece, it sort of acts like that SEP that we looked at. You can defer 25% of your business income. If you're on your own, it's 20% if you're on a flow through. Then you go to the other side, and that operates much like a 401k. So the maximum contribution into a 401k this year is $19,000. You can put that in that side. If you're over the age of 50, you can put another $6,000 in there. The maximum you can put into this each year, again, is going to be your $56,000 a year. But that's really hefty. Again, you can have this regardless of how you're organized as a business. This one is a little bit more onerous to set up, and also this one has an annual filing requirement. Once you get that account over $250,000, you're going to have to file a 5,500 or hire a CPA to do it for you. So a little bit more expensive. Let's go on to talk about, did this work? Yeah, choice of business entity. We talked about sole proprietor, which is really you haven't organized it at all, but hopefully you're operating out of a bank account. You have a separate Schedule C on your 1040, your tax return. Then there's a partnership, and usually real estate, oil and gas, we use that. Most folks, like the Pilates or senior, we went from sole proprietor real quick. She hired me over to an LLC. Once a limited liability. And this is quick and easy to set up. You can use legal forms from LegalZoom.com or Nolo.com. Fill in the blanks. I looked up a Kansas LLC. It costs $99. That is cheaper. So that would be a good idea. There's also an S-Corp. S-Corp is one also has been on a long time. And if you are a small business or either with employees or without, well, probably with employees, you might want to take a look at this one. This is interesting to use because you might be able to save the 15.3% FICA tax on it. And so we've done this a couple of times with clients, not often, but if it suits, it's a wonderful thing to use. So over here on the tax return, does this bother you when I switch back? Okay, is it working? So over on the tax return, this is your 1040. Your W-2 money comes in here, and you're paying 15.2%, which is your business, whether or not that's your tax. Then the other part of your business, so your S corporation comes in over on Schedule 1 on that one, and you don't pay FICA. Okay, so this is why I think it's worth to talk with your CPA or yourself if you're doing your own. Let's say that I own a pie company, and let's say that I make pies, and I am known far and wide. We'll come from all over for my, and I've hired a couple of freelancers. They come in, a couple of half days per week. Sorry, thank you. Is this good? A couple of half days per week, and they collect the cash from the customers, and they get the pies out of the fridge. We're operating this business out of my own kitchen. And so let's say that I net $100,000 this year, okay? Well, I am the whole business, right? If I get sick, nothing happens. So all of that 100 grand is probably going to have to come up here, and you're going to have to pay 15.3% FICA on that. But let's take a different kind of pie company. Let's say let's say this time I couldn't bake a pie if my life depended on it. But those two grand ladies, one of them can make a terrific banana cream pie, and the other one can make a terrific cherry pie. And let's say they come in there 2 half days a week and they are very productive. I have gone out and set up a commercial kitchen with the best equipment. And so they make a lot of pies when they're there. And let's say the other thing I've done is I've gone out and hired 2 teenagers, and they show up for their limited half days and they collect the cash and get the pies out of the commercial refrigerators and deliver them. Oh, and the other thing that I do is I make a phone call once every 2 weeks to the local newspaper, and I say, would you please run the ad you ran last time for us? Okay, so what am I worth this time? Here's how the IRS looks at it. It says, I have to pay myself on a W-2 salary reasonable compensation, and I have to take into consideration the services of the shareholder, that's me, right? I own it all. The services of the other employees, my 2 grand ladies, and then the capital and equipment that I have set up. So this time around, this is a very different business, right? Without me, if I'm sick a day, that business still runs. I think the best sentence out of the IRS instructions is, what would a comparable business pay for someone like me? You know, I've hired the 2 teenagers and I'm making a phone call once every 2 weeks. What would you pay me? Maybe 20 grand? Something like that. So let's back up then. In this case, let's say my same business, this time though, it still nets 100 grand. It looks very different, doesn't it? Let's say the 20 grand comes up here and you pay the 15.3 FICA, but the 80 grand is coming through here, and rightly so, and you don't pay FICA on that side. So that's why I think if you have a business that may be appropriate, you might want to think about how you're organized as a business entity. I told Bob that we would go over the rules of qualified business income deduction, and we're going to take a simple case. I went through the IRS's, I think it was a 2 or 3 hour course that they gave on this. I got this at CPA Academy, and it's a free course if you want to go through it. The QPID is, for individuals, it's a deduction of 25% of your qualified business income or 20% of your taxable income less your capital gains. Your qualified business income is what you and I think it is going to be. It's nothing different. It's your income, it's your gain, it's deductions that you have, and then loss. And again, it's for all your typical, it's not for C Corps, but it's for all the rest of your business entities. This is the simple computation. That's how we're going to go through. It's the lesser of that 20% here or 20% here. And this applies if you're filing married joint and your taxable income is less than $317,000, or if you're filing single, it's going to be $158,500. Once you go over that, then you get into that specified service trade or business, and it phases out after 100 grand up. But we're not going to go through that today. So we're going to take an example of Abel, who runs a bakery. He's single. His QBI is 100 grand, and then he has taxable income of 81,000. He has a net cap gain of 7,000. So his qualified business income deduction is the lesser of 20% of his bottom line. So that's 20 grand. Or here's the taxable income less net capital gain, that's 74. 20% of that is 14,800. So that's why he has a qualified business income deduction of 14,800. And this number can get pretty big. You know, I've seen, you know, like one of the clients is a partner at one of the big law firms downtown, and those are flow-throughs. So, you know, that can get pretty big if you're not stuck in one of those qualified service trade or business ones. So this is the last strategy that you might think about as a small business owner, and that is, if you're on the cusp of retirement, I would strongly encourage you to think about keeping the side gig open. Downsize drastically to the hours that you want per week, if at all possible, and then think about it. Couple of good reasons. One is that it lets you generate income in your field of expertise. You get paid a lot more there than as a Walmart greeter. So one of my clients I worked for, they were in marketing, and they have a business, and they are able to generate a fair amount from that when they want to. You know, they've kept on some clients. Also, though, they can pare it way back. Like the year her mom died, you know, their business earned nothing because they were busy with her mom. So, but it's a very nice fallback plan, especially if your retirement portfolio isn't as big as you would like it to be, especially if you don't have a lot of confidence in the stock markets in the U.S. to be able to provide, you know, retirement income over 30, 40 years. So it's a nice backup plan there. Second thing for keeping the side gig open a little bit longer is it gives you opportunities for deductions. You know, so a lot of folks I see are able to deduct internet, are able to deduct cell phone, able to deduct some meals, perhaps some travel. I think the best example of this that I've seen is a couple that they used to have a large acreage outside of Kansas City, which had several buildings on it. And one of the buildings they had converted to a gift shop. And so it was only open on Saturdays, and not every Saturday out of the month. But every vacation that these two had was deductible because it was always a merchandise shopping trip. You know, so they would go antiquing or go looking for estate sales. And, you know, I don't do tax returns for my clients, but they had worked it out with their CPA, what they had to document, but they got a lot of deductions from their side gig. So, and they were very passionate about it. So that's all we're going to talk about from the business side. We're going to then switch over to the individuals. Let me see if I can get here. When you're saving for retirement, you want to save smart, get the biggest bang for your buck that you can. So here are the 6 common ways that folks save for retirement. First of these is to save up to the company match in your pension. So a lot of companies, most prevalent is probably 50 cents on the dollar up on the first 6%. You'll get a company match. Sometimes companies I've seen will do dollar for dollar on the first 3%. I've seen matches that are better than that. I've seen matches where there's no match at all, of course. But that's an immediate return on your money. The second best way to save is to use IRAs. The Roth IRA is good because you're getting it again into an account where you grow it without the headwind of taxes. But the beauty of the Roth is that when you take it out in retirement, you don't pay tax then either. If you can't do that, and qualifying for a Roth IRA, your adjusted gross income needs to be below 193 filing joint, below 122 filing single. But if you can't qualify for that, then you might be able to qualify and get a deductible IRA. If you don't have a pension plan at all, you can get those. Sometimes if you're a spouse, you can get a partial deductible IRA, but those are a good means too. And on all of these, you're trying to get money into a tax-deferred or tax-free environment so it can grow the quickest. The third best way to save then is to go back to your pension plan and maximize the contribution there. And again, that is $19,000 for a 401k, those types, $13,000 for a simple, they all have catch-ups. Health savings accounts are an odd duck on the list, but I include those because whatever you put into a health savings account, you get a deduction for it. And it's tax deferred. At the age of 65, it in essence turns into an IRA. Let me see, you can put $7,000 for a family in here, you can put $3,500 for a single, and you'll get a deduction. The reason I put low earnings potential is that when you hunt around for an HSA that gives you investment options, they tend to nickel and dime you, so you lose some of your return because of the higher expenses in it. I've never really found a good one. I of all people would use it if I could find it, but I use an HSA, but I don't try to invest out of it. The next best way to save is if you couldn't qualify for either of these two up here, the Roth or the deductible, at least do a non-deductible IRA because you are still getting money into an account where it's going to grow without the headwind of taxes. And you will, if you let's say you put $7,000, you're over the age of 50, into a non-deductible IRA, and let's say it grows to 15 grand. When you pull it out in retirement, let's say you took it out all in 1 year, you would only pay tax on the 8, because that 7 that you put in becomes cost basis. This 6 is an annuity. I've used these a couple times. You have to have a special situation. They are sold very well. They give great commissions to salespeople. To make an annuity pay off, if you run the numbers, you need to be in the higher tax bracket, say 37, 35%. And secondly, you need to expect to stay in that marginal high tax bracket for 10 years at least, if not 15. And the other thing, if you're going to use one of these annuities, choose a cheap one. I like Vanguard. TIAA-CREF has some cheap ones. Emeritus has them. Those are just for advisors to use, but expenses matter, so you want to keep those down. And then the last best way to save is just a plain old vanilla taxable brokerage account. You do face the headwind of taxes every year, but you do enjoy cap gains rates on long-term cap gains and dividends. Okay. Let's talk about tax shifting. I don't know if that's the formal term for it. I've never really seen what it is called. Let's say that you are planning on winning the lottery, or you might be receiving a nice inheritance, and several clients that's been the case there. You might be selling a publishing company in Chicago, and I work for a great guy who's been doing that. Or you may be doing substantial downsizing. You may be in a $250,000 house, or $750 house, and then downsizing to a $200,000 condo. But anyway, you have a big influx of taxable income, right? Something you can do if you are still earning money is do some tax shifting on it. And here's how this works. I've done this with clients, and usually the first year we set it up and they get their toes in the water. And then in the second year, we'll say, can we really, speed this up, rev it up? And we will, if we need be, we'll take the whole paycheck down to $200 or something if we can do it. But this is a good tax strategy. Let's say that you have won the lottery and you have $200,000. And so you stick that in a taxable account, okay? Let's say that you already have $3,000 in your pension plan. Let's say you're making $100,000 a year. And from a financial advisor's perspective, this is great, but it's a tough portfolio to work on, okay? Because every time I turn around, I have to look at taxes. So let's say that we can convince you to put $25,000 into your pension plan, your IRA. Let's say that's $19,000 maximum contribution, and then you're over the age of 50, so we'll get a $6,000 catch up. So we're gonna drop this like a stone, right? You were getting $100,000 less taxes going to your bank checking. Now it's going to be $75,000 less taxes going to bank checking. So we scoot that over into this pension bucket. But what I've promised you is, hey, I'll make you even. We'll take enough out of this account, send it to your bank. We'll keep the same spending level. What we do then is put $19,500 into bank checking, and you don't notice the difference. You buy the same bags of groceries at the grocery store. And the difference between the 25 and the 19 is compliments of Uncle Sam, the IRS, because here you were paying taxes on $100,000, and now you're only paying taxes on 75. What you put into the pension plan, you escaped taxes on that piece. So if you keep this up, after about 9 years, this thing is sitting at about $20,000 plus growth. This thing, all of that went over here. And so this is a much nicer portfolio to work with, and it's going to grow faster because it doesn't have, the headwind of taxes on it. This is not really a strategy, it's more of a bummer, but it's a report we use for clients every year. This is, $1 million isn't what it used to be kind of thing. But let's say that you are on the cusp of retirement. Let's say that you're making, let's say your retirement phase is going to be 32 years if your life expectancy is 99. That's this number. Inflation long term is about 3%. I know that the short term is 1.7, 1.8, but really long term, is about 3%. Hasn't moved much. Let's say that the return on your portfolio is about 6. Let's say that your costs of investing are about 50 basis points. And so if you run this for you, those of you who like Excel, like I do, and run a tools goal seek, that's all this is, this whole worksheet. But it's very linear, and the clients like it because it's so easy to understand. But, you can set this up. So what you do is you run it so that you take the same amount out every year. And if you have $1 million and you save that and you're on the cusp of retirement, this portfolio is going to throw off about $44,227, roughly $45,000 for your lifetime. And you'll spend the same bags, buy the same bags at the grocery store each and every year. So let's say that your Social Security is going to kick in $30,000. So this is the kind of savings that somebody who's making $75,000 a year probably ought to have as a target, as a goal. If you and your wife are each making 75, you can just double the numbers, type of thing. This is something that, I've used with clients, when they have young adult children and they're getting married. So the clients want to give, their child money for wedding costs, or they have a down payment on a house, they want to help, or there's some other one-off reason. So what we do is, instead of giving, you can give $15,000 annual exclusion to your child. If you're married, then that's 30. So let's say this, we're going to give $30,000 to the young child. We'll just say Jimmy. We're going to give Jimmy $30,000. Well, we don't want to write him a check, So what we want to do is we look at the portfolio, the taxable account. What is the highest appreciated investment we've got? So let's just, to make the math easy, I'm just going to say it's 30 grand and cost basis is $1. So the clients are taxable income between 78 grand and this. That's a lot of them fall right in there. And that means that if the client sells that, you know, we're going to pay 15% long-term cap gain rate. So that's $4,500. And so it is definitely worth it in this case to open up an account for Jimmy and transfer that over to Jimmy and have Jimmy sell it, and then his long-term cap gain rate is 0. And for young adults, you know, right when they're out of college, their salary can be this. The standard deduction is pretty high now. So, you know, they're falling into this for 3 or 4 years after college. So it's a good idea to keep in mind. Give the capital gains to your children and let them do the sale. And hopefully they won't have to pay tax. This is something that you can do for yourself. What we do for every client, for every taxable account, mutual funds have a year end. It's not calendar year end, it's fiscal, 10/31, and usually by November they know what their numbers are going to be. And if a mutual fund has sales throughout the year, they can net them against losses, but then whatever net capital gains that they have to distribute out to shareholders. And that's you and me when we're sitting there buying a mutual fund, holding a mutual fund. So what we do for every client, for every taxable account, usually don't end up doing this for ETFs because they don't dump like mutual funds do. Usually don't end up doing this for bond mutual funds. Always do this for stock mutual funds. But we download the cost per share, we download the market value per share, we download the number of shares that client owns in that account. And then we go over to this. This is one place we go to. We go to several places, but I listed this one here because it has a lot of them in one spot, a lot of mutual funds. But we go and look at the record date, and we look at the distribution per share for that mutual fund. And we add that to the worksheet. And so what we do is we calculate what is the total distribution we're going to get on this holding, and what will the tax be on that. And then we take a look at what is the capital gain we would pay if we sold that holding before the record date, and what would the tax be on that. And so if the difference, I usually think the difference needs to be 1 or 2 grand, and then that will do a step aside. So I just took an example here. Let's say this is mutual fund A. Let's say that this is something that I own and I have 10,000 shares. The market price is $30 a share. They're going to dump this year. They don't have any capital losses left from 2008. So all the gains they've made throughout the year, they've done a bunch of shifting. So they're going to have to distribute $4.50 per share, which is, you know, what we call a dump. And it's not that unusual. Usually out of a dozen holdings, you know, 7 of them mutual funds. It's not unusual, especially 11 years into a bear market, to have 1 or 2 mutual funds doing this. Let's say I bought this maybe 15 months ago at $293,000. So, you know, it's only worth 300 grand, right? But the market's gone sideways the last 15 months. So I only have a capital gain of 7,000. So what I calculate is if I stay and take the distribution, I've got 10,000 shares at $4.50 a share. That means I'm going to get hit with $45,000, which is pretty bad. 10% tax rate. My tax bill will be $6,750. But the other option I have is to step aside, right? If I sell this thing, my capital gain is only going to be 7 grand, and I'm going to pay 15% long-term cap gain. That will be a tax bill of $1,050. So the difference is $5,700. So I think I'm above a break even, you know, worth doing something about it. You need to sell the day, you can actually sell the day of, but you need to sell the day before record date, what we do. And then we go, I would sell my 10,000 shares at 30, I would get 300 grand. And then the day after record date, I have my 300 grand, but the price has dropped to $25.50, and so I get to buy more shares. I get to buy actually 11,764 shares. But you might ask, why has the price dropped from 30 bucks, excuse me, down to $25.50? Yeah, exactly. The cash came out of the mutual fund. So, well, it's committed to come out on the date of record. So what does my balance sheet look like under each scenario? let's say that I stayed and took the distribution, okay, which is what most folks do. So I've got at the end of this week, I've got my 10,000 shares. The share price has dropped to $25.50, so my mutual fund is worth $255. I got the distribution, right? I got my 45 grand, so here's my cash. And I also got that tax bill that I'm gonna have to pay, $6,750. I'm gonna have to pay that on it. So my position then is $293,250. So, but let's say I took the other option. Let's say I did the step aside. And so here's my fund A. I've got those 11,764 shares. Remember, I had 300 grand and I got it cheap at $25.50 because the record date had passed, right? So I have 11,764 shares at the $25.50. So that's darn close to 300 grand again, just a few bucks off because of fractional shares. And then I still, though, I had that capital gain of 7,000. So I have a tax bill I'm going to have to pay, and that's $1,050. So my balance sheet this time is $298,932. And the difference between my two positions is the tax of $5,700. So that's why it's worth it to take a look at your taxable accounts. And you can check around middle of November. They'll know what they're going to distribute, and if it looks like it's going to be a dump and a big tax difference, and the tax difference is different for each client because not all clients buy at the same date, the same time, at the same price. One client may have a 7,000 capital gain, another may have a 40,000 capital gain. They bought 2 years earlier, something like that. So you have to take a look at, when you specifically in your accounts, what that looks like. Let me back up. I want to talk about one more thing in here. And actually, it's over on this page. This gets really worse. Clients will call you up and beat you about the head if they got a $45,000 distribution and the holding they're in a loss basis on. Fortunately, this hasn't happened to me, but I've heard horror stories. So let's say that you've got a client who has a 10 grand loss in something and you're not looking and they get dumped out with 45 grand. They're going to notice that, or CPA may tell them about it. So you don't want to do that. Back in 2008, everything we had was in a loss position, and we looked like every other financial advisor firm, down the street. There was no way you weren't showing a loss. So you call up all the clients and you say, what we want to do is some tax loss harvesting. So you look for a fund or an ETF that has a high correlation to the holding. And this all assumes that you still like this fund that has a high correlation. So you sell, you take the loss, and you immediately, the same day, you buy the lookalike fund. If you go to Morningstar Research, there's a tab there, funds most similar. On Schwab Institutional, there's a tab. I can go look at some similar funds to it. So, it's widely available to find funds that look like the fund that you own. But you want to avoid the 30-day wash sale rule that the IRS has. So you sell your mutual fund, you take the loss, you book that over to the tax return, you bought the lookalike fund, you wait 30 days, and you flip that trade. You sell the lookalike and go back and buy the fund that you like. But what you've done is force the loss over to the 1040. And in 2008, we had a lot of losses we were forcing over to the 1040 tax return. But our clients didn't pay taxes for a long, long time. I think the portfolios got back to break even middle of 2010, but we did not pay taxes because you net those capital loss carry forwards, net them in capital gains for the years to come. If for some reason you don't have any capital gains coming anymore, you can still net against $3,000 of ordinary income each year. And those things carry forward for forever, so it's worth doing it. How am I doing on time? I have 10 minutes. Oh, no. This is good. I must have skipped something. Okay. This is the last thing I have to talk about, and it's only relevant for those of you who have itemized deductions. Obviously, for someone like me, I'm going to think don't ever give cash to, don't ever put money in the Salvation Army bucket, because you want to get a deduction for it, especially if you're itemizing, right? So you always want to write a check or use a debit card online or use a credit card so that you have documentation. But usually what I recommend is giving appreciated securities. So if I give an appreciated security, let's say that I give $6,000. Let's say best case scenario, you know, I bought it 1 million years ago, my cost basis is 1. But really just go through your portfolio to the taxable account, you know, sort it by unrealized gain percent and pick the one with the highest percent. That's what you do. So let's say that I give $6,000 of appreciated securities, cost basis of 1, I give that away, right? And let's say for the math that my marginal tax bracket is 33%. So that's going to offset $6,000 of income. That's going to save me about, you know, $2,000 off my federal tax bill. What Kansas does is they have something called a community service tax credit. They have another category called individual development account. What they do is they'll give you a tax credit on your state return for 50% of the amount of the charitable contribution to qualified charities. Missouri has this too. In fact, clients of mine have done it over on the Missouri side. It's a little bit harder to find those on Missouri, but if you look at their Department of Revenue website and make a couple phone calls, you can find those. Over on the Kansas side, when you look at the website, some years it's easy to find these charities who have gotten these credits awarded, sometimes not. I've worked with Interfaith Housing Services, TLC for Kids, that's a pretty well-known charity. They will get these. This one, I like this, Friends of Johnson County Disabled Services is another nice one. But if the charity has these credits to pass out, they'll market those, and if you keep an eye out, you know, you can find them. Or just call Kansas and say, what charity has these this year? But so let's say I've given away $6,000 of appreciated security with a cost basis of 1. I saved my $2,000 on my federal tax return. I'm going to come around then on the federal tax return, half of 6 is going to give me a $3,000 credit. That's from 1 for 1 off my state tax bill, right? The other thing though that Kansas is going to do is force me to put that $6,000 back into the income side and have me pay tax on it. So at a 5% average tax rate, that'll be $300 I've got to pay more on the Kansas state return. So I don't save all $3,000. I only save the net of these two. I only save $2,700. But a $6,000 gift of appreciated security then has saved me $2,000 on my federal and about $2,700 on my state. So I saved $4,700 on my taxes if I give appreciated securities. And so this is an extreme example with a cost basis of 1, but if you think about, there are other cases where you don't know cost basis that you certainly want to give it away and don't sell it because their IRS will force you to take a 0 cost basis. But you know, this is something else that some clients have used. It depends, you know, how you're charitably inclined and if you're, you know, which charities you like. So.